Asymmetric investing is all about finding stocks that can 10x in value over the next 10 years. And the first stock that I ever covered on the Asymmetric Investing newsletter is Spotify. That stock is up 426% since I wrote that article on March 31st, 2023. What exactly was I looking at Spotify, and why has this been such a resounding success? Doesn't get a lot of attention in the market today, but this is one of the top performing stocks over the last 2 or 3 years. And I think there's a lot we can learn about Spotify and where asymmetric opportunities can be found in the market. That's what I'm going to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. If you want more from me, including every stock that I buy every month, check out my Asymmetric Investing newsletter. That's where I cover stocks like Spotify, Robinhood, and Hims and Hers. These are some of the biggest stocks in the Asymmetric Portfolio that is absolutely crushing the market. If you want more of my research and access to the Asymmetric Portfolio, check that out. There's a link on the screen and a link in the show notes. If you're looking at a stock like Spotify, you're going to want to know things like how many users do they have? How many of those users are paid users? How many are ad supported? What are the margins in the ad business? All that's very easy to find on Fiscal AI. So if you like what you see during this video, you're interested in upping your research, check out fiscal.ai/ASYM. You can try out their product for free for 2 weeks, and then you get 15% off with that link. Definitely a platform that I use all the time. This is what my browser opens up to. It's so valuable for me. But let's get into exactly what I was looking at more than 2 years ago with Spotify. So this is what's a little bit wild with Spotify. At that time, the company's operating margins were negative, net income was negative, and they did have positive free cash flow, but those free cash flow numbers were not looking good at that time. But Spotify's strategy was pretty clear. They wanted to own your ears. They were going to do that with the music business, that was the core, and then the podcasting business. And this is the key, is they want to build an app that people love. The value in a digital world is what do people choose to interact with on a daily basis. When it comes to music, that answer was clear in 2023. It's even clearer in 2025. Spotify was the winner. It's not Apple. It's not YouTube. Spotify is the winner in the audio business. And that's really the value position that they started from. From there, we can dig into their financials, but this is what I wanted to show here. This is when the Spotlight article was written, right at the end of March, beginning of April. Since then, the stock is up 426%. So just phenomenal returns. But what exactly has happened with Spotify stock? Well, everything that you want to go right with a growth stock has gone right. There are 4 factors that can drive a stock higher: revenue growth, margin expansion, multiple expansion, and then buybacks. I'm going to push aside buybacks right now, because that's not something that we're really looking for with a company like Spotify that continues to grow. We want them to reinvest in their business, not invest in buying back stock. Let's go through those main 3 factors. The first is revenue growth. I'm going to break down where this revenue growth comes from in just a second. But in March 2023, they had $12.1 billion worth of revenue that has now grown to $16.6 billion over the past 12 months. So revenue continues to grow. That is a driver of the business, but it's not actually the biggest driver of the business. The most impressive thing over the past couple of years, and we knew some of this was coming, was the increase in margins. Let's start with this blue line. That is gross profit margin first. Couple of things were happening in 2023. They had already announced a number of layoffs at Spotify. So we already knew that kind of their operating costs had gotten out of control. Their gross margins were kind of stuck in the mud. But we knew at that point that Daniel Ek and the management team was really starting to focus, on, what? We need to be a profitable business. We need to get the operating leverage that typically comes with being a digital business. And that's not where they were at that point in time. So those margins were relatively weak. 25% gross margin at that time. Now, I thought they could improve that margin to maybe 30%, maybe a little bit higher than 30%. But remember, they have to share a portion of their revenue with record labels and artists. And there are only a couple of major record labels, so they don't have a lot of bargaining power over their suppliers. That's sort of the challenge for Spotify's business. This is one of the reasons that a lot of investors don't really like this business. These margins are never going to be the typical tech margins of 70, 80, 90%. 30% was kind of what we thought we would peak at. Those margins over the past 12 months, 32%, and they've been even a little bit better than that. A couple of things have happened. They've increased their prices. They've started to bundle more. So audiobooks are now part of their bundle. That's going to push their margins a little bit higher because they don't have to share quite as much money with those audiobook suppliers. And also the marketplace is kicking in. So the marketplace is essentially the advertising arm of Spotify. So if an artist wants to get their music out there, want to insert it in people's playlists, they can pay to be a little bit more of a priority on those playlists. That's what that marketplace business is. That is now a significant business for Spotify. They don't break out the numbers in the way that I would really like, but this is helping push these margins higher. Let's add in operating margins here, because this is the more important thing long term. Those operating margins, like I said, in 2023, they were negative, now 11.4% over the past 12 months. So both gross margins and operating margins are increasing rapidly. So let's break down a couple of those things. And then let's add in the other thing, that is multiple expansion. So revenue is growing, margins are growing. Those are both positives. But when you get both of those things, oftentimes you also get the stock price going up to a higher price to sales or price to earnings multiple. Since Spotify was not profitable in 2023, I think the way to look at this is the price to sales multiple. So 2023, you're looking at about a 2 price to sales multiple. Now that is 7.4. So everything else equal, the stock is up about 3.5x just from multiple expansion. It's not something that's going to drive a stock forever, but that can be a tailwind for a period of time, like it has been for Spotify and for a lot of tech stocks over the past couple of years. So now we're going to break things down into their KPIs. This is where I'm finding this is in AI. You get these segments and KPIs. So you got your income statement, balance sheet, cash flow statement. These are the operating ratios. You can look up stock prices in this ratios tab. But segments and KPIs is really valuable because you can pull information like this: the premium revenue and ad-supported revenue. So premium is in green. You can see that definitely drives the business. Spotify, and you have a choice. Hey, you can grow your premium business by 10% or your ad business by 10%. You're going to go with premium every single time. This has just been a steady drumbeat of growth. And what's been so impressive with the premium business is they have been able to add subscribers at a steady clip. Let's add these subscribers in this orange line. You can see that quarter after quarter after quarter, they continue to add premium subscribers. Now, the interesting thing here, I'm going to take away the first two and just show the subscriber numbers. There's actually more growth on the ad-supported side of the business. That is in large part because the areas of growth are mostly international. It's not in the US and Europe where Spotify really got its start. That's why it's primarily a premium business in those two markets. But when you look at Latin America, Africa, kind of the areas that they're going to be able to grow the most, grow their user base the most, those are areas that are going to be more ad-supported than they are driven by the premium business. So that's just something to keep in mind when you look at their numbers. But steady growth on both sides of the coin. But here's where things get a little bit more interesting. Revenue growth is great, but if you can't turn that revenue into profit, that's a problem for your business. You can see that premium gross profit just took off starting in the middle of 2023. So 2023, you've got a little bit of growth in the premium profit, but that goes from $3 billion to now nearly $5 billion. That's faster than they're increasing revenue. That's faster than the increase in the number of subscribers. So that's that margin expansion that I'm talking about. Where you're not seeing the same margin expansion is in the ad-supported business. So if you want to see an area of opportunity for Spotify, where could they improve the business in the future? Ads is always something that I think is a big opportunity. But the question is, can you be both a premium business and an ad-supported business? That's something that Spotify is going to have to deal with in the future. Hopefully they can kick this up a little bit more, have a little bit higher margins on the ad-supported side of the business. But the profit is really going to come from this premium business right now. This was the other key. Gross profit is great, but if you're not turning that into operating profit by covering all of your R&D expenses, all of your SG&A expenses, that's a real problem for the business. That's always been a problem for Spotify. So in green, you've got revenue growth that has continued pretty steadily over the last few years. But let's take that away and show what's happened to operating expenses. And again, this is when I wrote the Spotlight article. The expenses were kind of out of control, but we knew at that time that they had already announced a number of different rounds of layoffs, and there was sort of a delay between when layoffs happened and when cost savings were actually going to hit the income statement. This is what's a little bit strange about certain businesses, particularly European businesses like Spotify is. You're going to have a lag between an announcement of layoffs and when it's actually going to hit the income statement. But that was a real opportunity for investors because in December, in March, we knew that these costs were going to start coming down, but it didn't really start hitting until later in 2023. And then you see that has continued through 2024 and into 2025. These costs are starting to go up just a little bit as they're starting to do more marketing to grow the business a little bit more, but they have really done a good job containing these costs. Operating costs are actually lower today than they were in the middle of 2023, despite the fact that revenue has grown over that period of time. That's how you get to this margin expansion. This is how you go from negative 6-7% margins to a positive 11% operating margin. Finally is multiples. Multiples are important. What we pay for stocks is important. I want to pay a price where you have an opportunity for growth and multiple expansion at the price that you're buying a stock. So I don't want to be paying 100 times sales. That's just too much. That's where you're going to run into multiple compression as a bigger risk than the opportunity for multiple expansion. But as I mentioned, Spotify had an opportunity for multiple expansion. Now, I included price to earnings multiple in here just to show kind of where we were sitting in 2023 and 2024. These multiples were negative, makes it a little bit harder to look at. And even today, this price to earnings multiple, 155. So let's take that away and just look at the price to sales multiple. 2022, you could have gotten Spotify stock at 1.3 times sales. That was the biggest opportunity. Asymmetric investing didn't exist at that point. So right here is when I first covered this stock on asymmetric investing. The price to sales multiple was 1.97. Today, that is now up to 7.4. So that multiple expansion doesn't have anything to do with the business. It just has to do with the stock price. But again, we're investors here. We want the stock price to go up. So if you have revenue growth, you have margin expansion, and you have multiple expansion, that's where you get an opportunity for an asymmetric stock. Spotify has definitely lived up to that. The risks are a little bit different today than they were 2.5 years ago. Now there's a little bit more risk of, do these margins continue to expand? Maybe not the same opportunity that there was a couple of years ago. And does the multiple continue to expand? One of the things that I've learned over time is I'm not going to sell the stock because I don't think this is a crazy multiple, a 7.4 price to sales multiple. I think there could be potential tailwinds, could also be headwinds. That multiple could go back to 4x or 5x, but it's also possible that it goes to 10, 15. Once you own a great company, it's not worth selling it because the multiple gets high, because that multiple can always continue going higher. That's what happened with Robinhood this year in the asymmetric portfolio. That's now the biggest holding. That price to sales multiple is about 25. So multiples can continue going higher, but finding phenomenal companies that can compound their revenue growth, improve their margins, and have tailwinds from multiple expansion is really the way you find opportunities in the market. Like I said, if you want more from me, including another stock I'm going to be adding to the portfolio later this week, check out Asymmetric Investing, link on the screen and a link in the show notes. And if you like this platform that I'm using, Fiscal AI, check out fiscal.ai/ASYM. I can't say enough good things about all the value that I get from Fiscal AI. So if you are an investor, check that one out. And of course, don't forget to subscribe here on YouTube. Thanks for watching, everybody. See you here next time.